How's it going, Jeff?
It's going well. Thanks for having me today.
Are you perched on the top of the San Francisco hillside or
I was looking for a Los Angeles background, but Zoom all Cisco, so I went with that.
all right. Yeah, well, I mean, you spend a lot of time on top of mountains, so I figured that maybe, just
Yeah, that's true.
you know, it's a summertime mountain, not a winter mountain. Yeah. Oh,
Yeah, I save all my vacation for the winter, as you know.
I know. I know. I'm gonna join you one of these days for sure.
There you go.
So today, what I was thinking was, I wanted to talk with you regarding the title insurance. Obviously, you're in the title space, title rep for. Tell me just very quickly, where are you these days? What are you doing, and so on and so forth.
Yeah. So I switched to Commonwealth Land Title, their national division, about 8 months ago. I was the first American to 10 years prior to that. So it's the same job, business development, bringing in new title and escrow business for the firm.
Right. So, and that's a perfect lead in because what I really wanted to talk about with you was what does title actually do for those viewers that are like, kind of like getting into this space? What is title insurance? What's the background and the purpose of it?
Yeah, it's in a nutshell, right? We step in as an independent third party, right? And we ensure that the person and again, this is a dumbed down version. We can get into the weeds if you want to, but at its most basic level, we are ensuring that the person selling you the property or persons selling you the property are the actual owner or owners, right? So just think if you got into a real estate deal with someone, and they were on the records or the real estate records, how do you know that that person is actually the owner? And is he the only owner? Does he have partners, right? I mean, there's all these things that could happen.
Right.
The owners are, and then we deliver the property to the buyer free of any, unwanted encumbrances, liens. We make sure that the a loan on the property that the seller has, if they have one, is paid off, so that when the buyer closes on the sale, all that stuff is taken care of and all the encumbrances are cleared before transferring the title to the buyer.
So
That's
like
that's in a nutshell.
right. And so if I was gonna sort of restate that and summarize, essentially you look back. So a chain of title is a lot like a unencrypted Bitcoin. It's a history of everything that's ever happened. And when you record something on title, you're giving it you're sort of labeling that property with something, whether it's a right to extract oil from it or a right to collect on a loan or whatever that may be. And so you're looking at it and making sure that the next guy who's going to take over the property, in fact, has the right to do so, and that nobody else behind that ownership in that whole, that blockchain of well disclosed, events, that nobody has a claim on that property after you take over the property. Is that well stated?
Yeah, that's you could a good way to think of it too is it's sort of it's the opposite of something like your automobile insurance, right? You pay a premium going forward each 6 months or whatever it is to keep the coverage on the car, right? Title insurance is the opposite. You pay a one-time premium and that covers you for everything in the past up to the point of the sale, right? So we don't cover anything. We can't be responsible for what they do after they take title of the property. We are insuring everything up until the
Okay.
consummation of the sale. Yeah,
Skeletons, skeletons in the closet insurance.
yeah, and we deliver the preliminary title report, right, to the buyer and seller, and in that report, we're gonna state, all those encumbrances that we find. Anyone that has an interest in that property can be in the form of the owners. If it has an interest, right, you don't pay your loan, they for the pro if your neighbor has an easement to access a portion of your property, that's an encumbrance. All those things we list in the preliminary title report, as exceptions to coverage. and that gives the buyer the document to do their due diligence to see if they want to buy the property based on those characteristics.
So some of the things that I've seen that get recorded onto title are things such as like if a property has a homeowners association, which we don't have that in a lot of commercial properties. Ironically, right now I do have one where the property sits in a homeowners association. But things like homeowners associations and other types of restrictions on any given piece of property are normally recorded on title. Is that is that also correct?
Uh, a lot of times, homeowners associations are not necessarily disclosed in the public record. We cover a lot of those what we call off record matters, meaning stuff that's not recorded with the county assessor. We cover a lot of those off record matters in what's called our owner's affidavit, or they call it an owner's declaration sometimes. And that's a document that we give to the owner to say, hey, is there anything else out there that we should know about? Any other link, like off record liens? Do you have some side agreement with your brother? Did he lent you money? Like all that stuff is included in the owner's affidavit. And a lot of times, they'll ask the question, especially if it's residential, if there is any homeowners association, because if they are, late on their association dues and there's, back payments, that's all stuff that we need to, figure out. And so your escrow officer would be the one then to contact the homeowners association to make sure that, all they're up to speed on all their payments and their accounts are current and all that.
All right, so I'm gonna
But you and me deal more in the commercial world, so I don't do as much. I do residential here and there, but it's mostly,
right.
the vast majority is commercial.
So in you're raising a question. I'm going to ask this question because this is just off the top of my head though. So when a developer though is building a property, right? And let's say there's some type of a an HOA or whatever. Yeah, I was doing a development where there was an HOA that needed to have architectural clearance, and the county was aware that the architectural clearance was necessary prior to issuing a permit. So how does that work if it's not on title? I don't quite follow that.
Um, I didn't quite follow you, and you cut out for just a second. I'm sorry. Can you ask that again?
So in if a person is looking to develop a piece of real estate and there's something like a homeowners or a community board or whatnot that claims to have jurisdiction over what can be built, um, how does that city or municipal enterprise know that there's a restriction on what can or cannot be built based on like a homeowners association if it's not recorded on title? That doesn't make sense to me.
Yeah, I mean, most of they're called CCNRs, right? Covenants, conditions, and restrictions. Those types of things that talk about what you can or can't build, or what the buildings can look like, even Spanish style. Like in Santa Barbara, there's a lot of Spanish style buildings. Those are all, I'm sure those fall under some blanket CCNR that the city of Santa Barbara has. But that stuff should really be um, found, during the permit process. And that's a little bit outside the scope of what we do, right? We
Right.
can
No,
only,
you're right. So we can. There's a little bit of a sidebar, but it was kind of going down a little bit of a rabbit hole that just feels a little bit interesting. So the items that you guys are insuring for, this is essentially protecting the property owner that's taking the property on for the most part, and ensuring that they've got what they call a clean title to the property, and then you guys also kind of are part integral in the actual recording of the deed and whatnot. So walk us through what that really is.
so just kind of what happens at closing then? Is that what your
Yeah,
question is? As
essentially.
far as,
Right.
yeah, I mean, so what happens? So the title company, right, is the one that's issuing obviously the policies to the buyers and the lender if there's a loan. So the title company, uh, we get all the money, right? So when a deal closes, all of the money, the earnest money deposit from escrow, if the buyer is paying cash or getting a loan, whatever it is, all the money comes into us because we are the ones that want to be sure to make all the payoffs of any existing loans, right? Or any,
Interesting. So escrow
mortgages
doesn't
or
actually
liens.
do that. It's title that does.
No, yeah, we do it because we want to be sure because
Yeah, it's your ass on the line. It's your entitlement.
exactly.
Got it.
Yeah, so we all the money comes to us. We pay off all of the existing debt, and then we send the proceeds for the seller back to escrow, and then escrow distributes those to the seller or sellers. And then we go ahead and record the documents. Um, in a traditional closing, we get the money, we record, and then we disperse the seller's proceeds. There are times we can do that in reverse in what's called a gap closing. Say, for instance, if one of the parties is under a 1031 exchange deadline and they have to close that day, there are ways around it. But yeah, we can do it both ways. And then we issue the policies and then move on to the next one.
One of the conversations that I've had, like just in industry wide on the brokerage side, is there will be times when somebody wants to work with, a title company or whatnot that's maybe affiliated with an escrow company or whatnot, and you probably can speak more authentically to this. Is there a and this is a great opportunity to plug yourself, but it's also an opportunity to tell us the truth here. So is there really a difference? Where is the value and where is the difference between, let's say, a Chicago title or a First American versus, and we'll start with this dichotomy. There are third-party title companies, right? Where my understanding is they basically are white labeling a major sponsor of there's primary title companies, and then there's these sort of like third-party ones. So can you explain the difference between
Yeah,
those two things and for us?
sure. Yeah, yeah. So you've got basically about four major players left in the title insurance industry, right? You've got Fidelity. I'm under the Fidelity blanket, right? I'm sorry, umbrella. Um, Commonwealth is who I'm with. We're under Fidelity. So if you got Fidelity, Chicago, Tycor, Commonwealth, Lawyers, all those are Fidelity brands, right?
Okay.
And then you've got Old Republic, you've got First American, and then to a little lesser extent, Stewart Title. Pretty much anybody else out there, like an Orange Coast Title, those are agencies, right? So those are underwritten by one of the bigger companies. So all these other smaller title companies that you see, um, are perfectly legitimate. They're just underwritten by one of the bigger title insurance firms. So that's
Okay.
that's the difference. But it's really in the last 15, 20 years, it's really consolidated. There's much, you know, it there's much less options because of Fidelity buying up so many of the brands, First American buying up a lot of the brands. Um, but Fidelity is a little bit different in that they buy a brand and then they operate the brand as is. So they buy, let's say, Commonwealth, and they let Commonwealth operate under the Commonwealth name. First American buys a company, and then they convert it to First American, basically.
Right. So they're sort of allowing the appearance of company.
They want one name and one company, yeah.
So
Whereas Fidelity has a bunch.
so Steelman the scenario is there. Why would somebody go to a company that has that's, let's say, like that? I don't want to use brands for the sake of it, just but a company that is established as a title insurer, but they're basically buying policies from one of these major labels or brands. So is there a reason why that would make sense? Why
Why they should go to a
Why the
smaller
co yeah,
agent.
is there a reason why a consumer, benefits from that type of arrangement?
Um, Not really. I mean, you know, in especially in California, all of the title companies, if you look at something as simple as rates, like how much you're going to spend,
Right.
they're all pretty close, right? We're not too far off. If you look at all the fee schedules for all the title companies, they're not going to be drastically different, right? So from a pricing standpoint, it doesn't really make that much difference. What it comes down to, and you see these smaller title companies like an Orange Coast doing more residential, more cookie cutter type transactions. The commercial deals can be much more complicated.
Right.
So you typically see the more of the residential folks going to those agents, and then as you go up the commercial ladder of deals, like the higher and higher the purchase price, you're almost always going to see one of those major brands, and that's because they just got more personnel, more know-how, more underwriting to do those types of deals than a Provident title or a small title company.
So I guess what you're sort of saying is that if you're not doing a technical project, or you don't run into a big problem on title, then issuing a title policy is for probably the majority of properties. That's a commodity, and if you have a relationship with somebody or your real estate agent has a relationship, that's probably a safe path forward. Um, if and that's the big question, if there's not an issue that comes up.
Yeah. Yeah, I mean, some of the biggest problems I see at times are, Joe Smith owns a huge industrial building and his best friend, is a title rep for, USA Title or whatever, some small residential title company. And then he names that person in the contract to handle the title insurance. And then we have huge issues because they're just not really equipped to handle a $50 million industrial warehouse transaction in the valley or something. So you really want to be careful when you're getting into the higher liability, more complex deals. You really want to go with someone that, knows what they're doing. And the other thing too is those smaller title companies, after a certain threshold of liability, they've got to go get approvals from the person that's underwriting them. So
Right.
the communication and the response time can get slowed because of that extra step that they have to jump through.
And that was, candidly, that was my experience with, we had an escrow where we had a third party that was being dictated by the seller, who ironically was like a boutique, real estate firm. And there was this horrible communication when we realized that I think there was an encroachment issue with a easement, and it was getting in the way of the developability of the project because it was basically a, redevelopment project, and that the timeline to getting feedback as to where the utility pole, whether or not it was an active easement or whatever,
Yep.
or could be removed, was got deeply in the way. And not to like plug you a little bit, but one of the reasons why I it stands out to me, a memory that a deal that we worked on was when we were doing the Rose Hotel, and if you recall, there was a bit
That's the one in Venice, right?
on Venice, right? And
Yeah,
it
yeah.
was a deal breaker. The buyer called and said, "We are canceling escrow. There's just I don't see a path forward. The property sits on somebody else's land because the way that I don't know if you remember, but it was like the building was built and the survey was wrong, and there was a real problem.
There was a small approachment up, I think.
It was
That
a
was a while
low
ago, but yeah,
encroachment. I
I
think
kind of remember that. Yeah.
the line lined up, and it was, it took me and you and lead counsel to to sort of work through and come up with a workaround where the title would be willing to insure it. And it was 2 weeks of calls, um, until we
Yeah.
got till you got the right person on the phone, and we solved that deal, you know?
Yeah, and you really wanna have you're talking before about the differences in title companies. You really wanna have someone, with access to what I call creative underwriting, right?
Right.
A lot of times underwriters will just say flat no, like, "We need this." But I always try to multiple sources, go up the food chain a little bit, talk to underwriting counsel, and sometimes, they've seen some situation where they've got a workaround where maybe the title officer doesn't know about, so I try to go that extra step to find answers that exist.
Right. Right. So that, I mean, that was a really good example for me as to why that it, you know, the title does matter, and who you are working with matters, and it's not necessarily a plug that everyone needs to work with me and you per se, but that was an example of a time where, with the without the right person working the deal, that I don't see how that would have come together, because title was not going to issue a policy. It was done.
Ye
You know.
Yeah, yeah. A lot of times with those smaller encroachments, if they've existed for a long time and kinda operating as is based on the size of the encroachment, there are times when the title company will just say, "Look, it's been like this for 50 years, and probably nothing's gonna happen, and then we'll give you insurance on it."
Right.
And I think that's what happened on that one. It's been a while, but I kinda forget. But,
We had to do
yeah, a lot of people think.
I don't remember. I know that we had to do there was some particulars to the encroachment that we had to figure out what we were doing or not doing. Maybe there was something to the effect of like, well, we're not going to insure that part of the property or something. I forget what it was specifically, but
Yeah, it's been a while for me too to
yeah.
recall. Yeah.
That particular one. Well, so and that's an example of a deal that sort of required title work, but is there is there some other deal that you can recall in maybe more recent history where you said, "Wow, that was interesting. That was a differentiator from a title standpoint, from solving a problem for a client, allowing something to move forward."
Oh gosh, offhand, you kinda caught me off guard. There has been times, my memory is escaping me right now. As a title rep, right? I'm not a title officer. I'm a business development person.
Right.
A lot of times we don't get into the weeds of underwriting. A lot of times I don't hear anything about a deal if it goes smoothly enough because everyone's doing their job. It's when there are problems that arise is when I start getting calls and have to jump in and make sure that the requests are going to the right parties and people are responding kindly and all that. Offhand, I can't think of one, but if you give me some time, I might be able to as we toss along here. Yeah.
It's all good, my friend. Um, when you are being in this sort of title development business, which is to say you're in sales, you're out there kind of basically, you know, um, beating the bushes and drumming up new business within your community. Does that mean that you work primarily with the agents in the market, or do you work directly with principals? How do you go about getting business?
Yeah, all the above. My clients, commercial real estate brokers, lenders, developers, real estate transactional attorneys, receivers, um, or just guys that own a lot of real estate. Like I have a guy that owns a lot of apartment buildings in LA and he doesn't buy or sell too much, but every few years he has to refi 10 or 12 of them and we do all those. So it comes from various uh, avenues and it look, it depends on the market climate too, right? I remember we're back during the Great Recession. There just wasn't a lot of activity, so a lot of our focus was going to the REO departments at the banks because they were the ones that had all the properties. So that it depends on the market, but yeah, that's kind of a general overview of my client list.
What kind of services do you provide to the agents in that are out there, generating the business for you? What do you do to sort of like help them acquire their business, along the way?
It's really it's sad. It's a lot of what we used to do we cannot do anymore because in 2000, it was 9 or 10, they passed that Senate bill, SB 133, which really limits a lot of what we can provide to brokers and agents and customers these days. Um, in old days, as I call it, we used to provide, a lot of things outside of just the property records, property profiles, and all that. And then after that law changed, it really narrowed the scope of what we can offer. So, I would say mostly these days, it's just property information. Helping them market their listing, whether it's through farm packages. getting a list of, certain types of owners in a certain area so they can send a direct mail piece. Or, a lot of times brokers will email me or call me and just say, hey, I need a profile on this property. I'm trying to get the listing and trying to find out who the owner is. So it's mostly property information
Property information. So I guess
because we have access to all the property records, right? So the brokers, hit us up for that information to do their job.
and so I'm kind of thinking, I'm putting my from the lens of the would-be investor, the investor that's out there, maybe the guy who's looking to become an investor, it sounds to me like for the most part, that investor needs to basically partner with a real estate agent in order to get access to the data that you have, by and large.
We Well, we and there's I didn't mention before, we also have, I mean, most title companies have it, but it's like an online property search portal
Right.
where they can go online, we give that to, we'll give it to anybody that's a potential customer. I mean, if we wanna earn, goodwill with that person, that prospect. So, yeah, if they reach out to us, and they're a legitimate contact, then, yeah, we would
Right.
we would work with them for sure.
So that would be is that, so for again, for that investor who's like, okay, I'm trying to learn about how to go about doing this. There he's got two paths. He can contact a guy like me and say, hey, I'm interested in learning more about this. What data can you get me? And then I can go get it. I obviously am aware of these portals because I use it, almost every day. But alternatively, they could reach out to somebody in title as well and gain that type of access so that then they can kind of, reach out. And some of those portals are available, publicly, but you just have to kinda know how to find it, but establishing a relationship
Yep.
with title officer direct is not outside of the realm of of a potentiality.
No.
Yeah, okay.
Yeah, I mean, you really wanna I always say that, I mean, if you're an investor or, anybody that's engaged in, transacting real estate, you should really try to develop a relationship with someone, or even if it's a couple of companies, just because, I can't tell you how many times, um, I get a call from a really good customer and there's an issue. Um, and the fact that that person has, been a customer for 10 plus years, I'm going to do what I can to make sure that his challenge is, whatever challenge he's having, right, is solved, right? And so you want to have that person that's kind of your cheerleader, for lack of a better phrase, on the inside, pushing along their deal and getting responses to their questions, timely manner. It really benefits them and will make their life easier.
Okay, good advice. Good stuff.
Yeah.
What else is there, from your standpoint, what's happening in the marketplace? What do you again, you've got a slightly different lens because you're looking at it just from a title standpoint and maybe a velocity standpoint, but, not to give away, but, you're staring at it, you're investing, you're sort of ostensibly in the market a little bit. What from your lens, what are you seeing right now, and what do you know?
Yeah. So a couple of things. So 2025, we are up. I don't want to say considerably, but we are up on resale volume. We are up on refi volume at this time last year. I was trying to get the specific numbers from the folks that do that, but I didn't get it in time. But I did talk to someone before our call, and they said that we are up substantially on both ends from last year. But the thing that I've been noticing mostly lately, because we track all of the loan maturities,
Mhm.
um, and because they're good leads for us, right? So we
Right.
find out what loans are maturing the next 3 months. We call that borrower and say, hey, your rate's going to go up. Are you going to refi? Are you going to sell? And there's a possible, title insured event there that we can call on and prospect.
Right.
But what we're finding is that a lot of these loans that are coming due, um, they're getting worked out. They're getting extensions.
Right.
They're not, lenders, I think, don't want to take the properties back necessarily. So they're much more flexible than they were in during, 2009, 10, and 11. So because I've still been waiting for kind of that, this huge number of defaults to come into the market, but it just
Right.
it just hasn't happened.
I'm not
It's amazing
even,
because,
I'm
Yeah.
working with a lot of newer built projects, and, there's a lot of debt that's, non-performing or is sort of zombie, right? Where it's like, well,
Yeah.
the property's worth less than what your debt is, but the lenders are they don't wanna go there. They're just,
Yeah.
kicking
I mean,
the can down the road and hoping that time because ultimately, I think there's a little bit of a consensus that time is going to, heal all wounds, right now, and so if for the lenders that can stick in and hang in there, that it might be the smoothest path out of it.
yeah. Yeah. I mean, if you think during COVID, with all the moratoriums on, no foreclosures, you couldn't kick your tenants out, all that stuff. You would think that all that would catch up with us, and at some point you would see this cascade of defaults and distressed assets, but it just you really haven't seen it like at least like I thought we would see it.
What about in office? Are you seeing anything happening on the office front or the lenders, doing the same thing?
Just office is more, personally in my own business, I don't chase the office market too much, only because a lot of the brokers that are into the office space, just do tenant rep, and so that there's no title insurance there, so there's no
Right.
business to be had. So I personally don't do that much. I have done 2 sales in the last couple of years, in LA County, some big office sales. It was, it was like, bought a couple of years before COVID for like 120 million, had like a $90 million loan with Chase, I think. And we sold it like 2 years ago for 60 million. Everyone took a bath. It was a short sale. We did 2 of those like year and a half ago about. So the ones that we are doing are typically short sales. So everyone's sort of agreeing to take a bath.
Wow.
Yeah.
Interesting.
And I mean, if you look, I mean, I look at like the news every day. Like I have different real estate feeds, and there's always a building here across the country, some office building that went for half what it did,
Right. Right, or a third or whatever.
8 years ago. Yeah, I mean,
Those
you
are
see 'em like
big.
yeah,
That's like a
those are big. Yeah, 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 yeah.
big different scale, and it's all collateralized and big sovereign wealth funds and whatnot. But on the smaller stuff, you're not seeing it. There's just nothing really crossing the path.
Yeah, and again, that's mostly because I don't chase the office market, so I don't have my fingers on the pulse of that market as well as the others, I would say.
Fair enough.
Yeah.
But in multifamily and commercial, it's not happening. At least not
Yeah, I mean, look, and I always try to tell my 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 customers, so especially the brokers, right? Like, um, I have a lot of broker clients, and I always try to remind them, like, "Hey, look, we had a really good run. It was like 10, 11 years of a really, really active and strong real estate market. It couldn't last forever, and downturns are inevitable. Just stay the course. Keep dialing for dollars."
ouch. Trying to Yeah, that's the truth. Ultimately, there's a in our business, we're in one of those phases where the folks that have an off ramp, are likely taking it, and
Yeah.
the ones that aren't really fully committed or have another thing that they could go do or whatever, they're going and doing it, and for the lifers, so to speak, we'll be here and we'll be on the other side and we'll be healthier because of it. It's like, pruning a tree and, starve the good lit and prune it and you got a healthier tree in the long run. So yeah, it should be okay.
Yeah, I think the same thing during these times is a lot of people get into real estate when it's just on fire, and then most of those guys or gals that get into that towards the tail end of that run, right? Don't typically last, and it kind of weeds out a lot of the what I like to call the weekend warriors a little bit, um, so, it's same for title, like, during the Great Recession, a lot of title people left the business because there was just hardly any business to go around. But if you stick with it, and you come out on the back end of that recession, there was, less reps in the field chasing that same pie, which is
Yeah,
for all of us.
right. It's all cyclical. It is what it is. Yeah. What else is making your life move forward these days other than work?
I mean, wow. Oh, I guess family mostly. Yeah, just family and snowboarding. As you know, I'm an avid snowboarder. I like to get as many days in as I can. I keep inviting you, but you don't come.
I've got, you had one child and I had three, and I keep using that as
Oh, that's
my
right.
my
That's right.
excuse. But they're getting
There
old.
was a
So
there was a method. There was a method to having the one kid. Let's
yeah,
keep
there. Yeah, there is a little bit of there's a little wisdom in that. I mean, I love all three of my children, but it does impinge on the on snowboarding for sure.
Yeah.
Uh,
Yeah.
all right, good stuff, man. Well, listen, let's we've got a couple of deals moving along right now, thank goodness, and
Yeah.
we'll keep it moving. And I appreciate your time here, and thanks for sharing a little bit about what title does in real life for everybody. And we'll talk again very soon, my friend.
Yeah. Yeah, if you aren't, again, thank you for having me. I really appreciate it. And if you want to get into the weeds on any, specific topics of title, on another episode, let me know. If you want to talk, ULA tax or something like this, let me know.
Well, I mean, that actually, I did want to talk about that. So we'll just keep on keeping
Oh, okay.
here. So yeah, so
Yeah.
actually, thank you for reminding me because I did want to jump into that. So ULA is huge right now, and that is a huge problem. In that there is for every deal that's over $5 million, there's a strategy for trying to get away from having to pay that tax. Um,
Yeah.
for the people that are not aware of what ULA is, it's a parcel tax on it was sold to the public as a mansion tax, but it in fact is affecting mostly, commercial and investment property owners who have bought real estate, held it long term, and now the property is worth over $5 million, and the tax is approximately 5%. It's 4% at $5 million, $5.3 million today, and and it moves up to 5.6 percent over like 10 and some change, and
Yeah.
has had a huge impact on the sales velocity. Anyone who owns buildings of that size, is looking at hundreds of thousands of dollars worth of a tax bill, and that has had a huge impact on sales trends in that category, and that's obviously having a negative impact on the goals and objectives of that tax. The tax was designed to raise a bunch of money for homeless housing initiatives, and the idea was that it was going to, raise billions and billions of dollars, but it hasn't done nearly that because no one's selling their buildings now because it's uh it's a pretty punitive tax, especially, for example, if you bought a piece of land for 1.5 million and you put $3.5 million into the construction, and now you have a $5 million building and you get subject to the tax, and your profit was
Yeah.
$600,000. So if you end up you just went to work for the government for the most part, and heaven help you if you bought a building 5 years ago for $5 million or 5.6, and then you sell it today for 5.1, and you're subject to the tax, and you end up you've lost money in two directions. So
Yeah.
there's no carve outs. Even the tax is not good, kind of period, but
Yeah.
no carve outs for losing money. It doesn't really care about that. So what are you seeing from a title standpoint? And are there any I think we could talk a lot about strategies that, the city of Los Angeles doesn't want to see happen, but are you aware of any strategies that are binding, that are safe, that are real?
Yeah. When this first came out, uh, two things. It was really funny because I think that tax went into effect. It was April 1 or whatever year that came out. So that March before that April 1 deadline of ULA tax was one of the busiest months we ever had because everyone had a property over 5 million, was trying to sell it before,
Right.
the tax went through. And in fact, on the last recording day in March, it was I'll never forget. It was a Friday, right? And so if your deal closed Friday, it wouldn't record until Monday. And so I had all these calls with attorneys like, "Hey, if this doesn't record, we're gonna sue you," because these were like $20 million deals, so they were talking millions of dollars in taxes, right?
Wow.
And we had all these calls from attorneys like, "We're gonna sue you guys," and we're like, in our position was, look, once we release for recording, if the county kicks it back for some mistake and like for whatever, like
Right.
it's out of our hands, right? I had 3 deals that closed that last recording day, and luckily they all went through. But man,
Wow.
I remember talking to a lot of attorneys that were threatening us. So that's just a quick story about ULA. What we saw mostly after ULA started was you own a commercial building on 2 parcels. Um, the strategy was split one parcel into Scott Rosenberg ABC LLC, and this one is Scott Rosenberg DEF LLC, whatever, or call it something totally different, obviously.
Right.
And then they would find one buyer, negotiate a contract where they would sell one parcel and wait a week or two, and then sell the second parcel. You had 2 different ownerships, even though they had the same underlying principal ownership.
Right.
And they would sell them separately to the same bona fide purchaser. And that was the strategy for a long time until 8 months, 9 months, a year later, we started getting calls from customers. And I've got one of these letters up right here. It's a letter from the county basically saying,
Oh.
hey, nice try. You owe us this particular notice. You owe us $660,000. And they also have in there, it said, uh, failure to remit payment can result in collection fees of up to 31%. So it would they're the bottom line, and what I'm trying to the point I'm trying to make is they're deadly serious and they're keeping a really close eye on this stuff. So if you've got a strategy that you're trying to, fool the county, it probably won't work. The only one that I kind of, and I'm not an attorney, so it's not what I'm advising you to
Wait,
do.
well,
I,
I don't know if we should be publishing this podcast.
yeah, the one that I've heard kind of passes, is if let's say you have an LLC, and that LLC is a single purpose entity that owns a building, right? And the building's worth 8 million. You sell it for 8 million. Instead of doing a traditional title and escrow sale, you sell you keep the LLC the same, and you sell no membership interest to
Yeah.
yeah, that's the one that I've heard. I haven't personally done one of those, but I've heard that that one has gotten through.
Right.
So,
Yeah, I mean,
yeah.
technically, if they're not selling the real estate, then
Yeah, but it's just you can just Google measured ULA Los Angeles, do like a Google News search, and there's tons of articles about how they're like collecting way less tax than they thought they would. It has not worked. It is stifling badly needed residential development because of the housing crisis. It's just bad all the way around. It needs reform. That's for sure.
I confess I met with some of the people that wrote the bill without, obviously not gonna get into names, but they were part of the council, and they were definitely in the they're in the business of doing good for the community and were very well intentioned. But but there was definitely a misunderstanding of how the economics of, like, developer economics really worked, and um, how when a developer is looking at a piece of real estate and they're developing something, they're not leaving anything on the table. They're not saying, "Oh, we're gonna offer the rents at, 3,500 even though we know we could get 4,000." And this person was sort of we were talking, and they said, "Well, we just figured the developers, they had enough profits that they could absorb it, and if they really needed to make money, they just raise rents on the tenants, and they just pass it on to the tenants." And I said, "Well,
Yeah.
that completely." I said, "Look, I'm not trying to demonize, developers, but, uh, they're gonna get as much rent as they can possibly get of that day. They don't leave anything on the table." And they're
Yeah.
trying to make as much money as they can, but as a result of that, everything gets cranked up, and you'd be surprised they don't actually make what you think they make. There's not
Yeah.
that kind of margin. When you take 5% off the top, you've taken anywhere from, 20 to 50% of the profit margin out of a deal. And
Yeah.
that's an awful lot of, you completely undo you're not going to go risk, hey,
Yes.
you want to risk an $8 million loan so you can make $500,000. Like,
Yeah.
that's not,
Yeah, and people are sitting on their properties. If it's more than 5 million, there a lot are just sitting. The transaction volume has plummeted. If we have, we see a lot of deals that come in at, like, 4.99 million, and then we're always like, oh, ULA sale, because it's worth 5.15, but it's better to sell it at 4.99 because of the more sense, and they even make more money. Yeah, yeah, yeah. So we see those a lot.
and they don't come after those. They're like, no, 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 we know it's worth more.
Yeah. Well, I mean, if you think about it, it's like at $5 million, at $5,000,001, you
Yeah.
pay $200,000 more in
tax.
property tax. Yeah, 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 yeah. So crazy.
Yeah, definitely agree. Well, one of the things that this conversation that you know illustrated was that they were trying to pass this bill, and one of the reasons why this bill is really kind of not going to do a whole lot is, again, uh, not trying to make enemies here, but the union, uh, the folks that were trying to put together, they're basically trying to raise money for homeless, and they're like, how are we going to do this? But they didn't have the money to actually put it all together. The union came in and said, "We'll give you $1 million so you can pass this law, help you write it and pass it and sell it and whatever. But you're gonna make all the work from the money is gonna be union." And
Yeah.
talk to a developer about what that does to the development costs when union labor has to come in. It's very it really moves in the wrong direction. The type of
Yeah.
increase in cost when you have to run a project through a $10 million build. And I'm not joking, like a $10 million build is a $15 million build with union. So it just
Yeah. Oh, yeah.
exacerbates everything. And then, people wonder, like, why is it costing $1 million a unit to build homeless housing? And you go, well,
Yep.
one
Yep.
name after another, and it just keeps stacking up and becoming more
Yeah.
untenable. And then the real person that's losing right now, right, is us, the society, and the homeless people. There's a lot of good people that are trying very hard to move the ball in the right direction, but it gets bundled up by itself.
Yeah. Yep.
At any rate. ULA, good
Uh,
times. Anything else? What
I'm
what else is in
yeah.
it? What else is in the
I'll
title
I'll
rule
tell you.
that is interesting?
Let me just leave you with this too, because I feel a little guilty about not having any insight into the office market. I did watch an economist lecture on the office market about a month ago, and he had a really good point. He said everyone, in the market, everyone's talking about the vacancy rate of all these office buildings, right?
Mhm.
And while it is a true and accurate number as far as what the vacancies are, it's not the number we should be looking at, he said. He goes, when you're shopping for a house, you don't tell your agent, show me all the houses that are vacant. You ask for the ones that would sell, right? And so he's saying the number that should be talked about in the office market is the availability rate, meaning, there's all these tenants that are sitting in their offices that would sublease their office of a second, right? All these tenants that once their lease is up, there's no way they're going to re-up. And he was saying that the availability rate is about 5 to 8% higher than what the average vacancy rate is in all these major metropolitan areas. And he said there is a huge shoe to drop once all those come to fruition, because you've got all these tenants that would leave on a dime, but everyone's reaching the vacancy rate. And I thought that was because I never really thought about it that way. And the bottom line being that the office market is way worse off than just what the vacancy rate says. And I thought that was a really interesting point.
I mean, I
Yeah.
I think that so is that the conversation that I've heard on this point, and again, we're jumping around a little bit, but the conversation
Yeah.
I have heard a little bit is that, most companies have returned to the office in part. It's the way that they're utilizing the space is changing. Um, by and large, most of them don't need as much space as they had in the past.
Downsizing for sure, yeah.
So
Yeah.
downsizing, but they're not abandoning offices in, I in whole. Um, and that depending on I heard a report recently that there was a new development on Fifth Avenue, um, the new skyscraper going up, that the high quality stuff is in demand. In fact, there's shortages of it. It's the fact that we have a lot of this sort of smaller garden, less prime office space that just doesn't make the cut and doesn't have a user. There's not a user for that type of product anymore.
Yeah. Yeah, I mean, we at First American, we gave up we had the 4th floor of 777 Fig and moved to a tiny office in Pasadena. And even that office was like, half filled. At least in our industry, a lot of people did not come back to work. And when we tried to force it, on them, they just said, well, title company X down the road said I could work for them and work from home. So, there was a huge shift in our industry
Generation. Yeah.
during, yeah, oh yeah, huge. I mean, people don't know it, but a lot of their escrow and title officers are working from home.
Yeah, no, I definitely picked up on that. Yeah, a lot of escrow where it's like, "Where are you right now?" Yeah.
Some are out of state too.
Yeah, no, yes, I'm dealing with that too. Yeah. Yeah.
Yeah, yeah.
They got loan odds.
There was one at my old job. There's two of that I know are like Utah, Arizona, but I mean they don't. They've got the little somehow their phone number stays the same and it rings. I don't know. They disguise it, but
Right.
that's how it is.
Interesting. Good stuff, man. All right, Jeff, nice talking to you.
Yeah,
Good to chat, and, we'll 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 keep this moving, my friend, okay?
yeah. Sounds good, Scott. Thank you very much.
No problem. Talk to you soon, bud.
Have a good one.